and welcome to Livewire's Buy, Hold, Sell. I'm Ali Selby. They say you should buy when there's blood in the streets, and there's certainly a lot of that going on at the moment. So today we thought we'd take a look at some of the ASX's most beaten down stocks to see which ones, if any, could be poised for a turnaround in 2022. Today we're joined by Simon Conn from IML and Bruce Williams from Elston. First up, we have accounting software provider Xero, which has seen its share price fall around 21% since the beginning of the year. Simon, I might start on you. Is it a buy, hold, or sell?
Yeah, Ali, we think Xero is a sell. Just on valuation grounds, it's trading on 134 times PE, very fully priced. And we think a stock that's really, if you see the price appreciation, the share price, a lot of that we think has been fueled by low interest rates and people paying a lot for earnings way out in the future. And it's a business that, whilst it has a strong market position in Australia, New Zealand, and increasingly in the UK, they're pursuing this big strategy of trying to conquer the US. And the US market is really difficult. They've been spending a lot of money over there on sales and marketing. It hasn't really shown a lot of traction, and they're simply managing the business to invest all the cash flow in chasing that dream, which we've got a lot of caution around.
Speaking of Xero's plans for global domination, they recently acquired a tax software preparation company in Canada. Bruce, over to you. Is it a buy, hold, or sell?
It's a sell for us, Ali. I agree entirely with a lot of what Simon said there. I mean, I think the core product is very good. They're building out their platform business, which is growing strongly as well. But on valuation grounds, we find it too much for us. We also think that competitive intensity is increasing, and the growth rate they'd have to sustain to justify the current valuation is greater than 20% for the foreseeable future, and that'd lead them to holding a very large part of market, and we just don't think that's achievable.
Next up, we have property powerhouse Charter Hall, which has seen its share price fall around 18% year to date. Bruce, staying with you, is it a buy, hold, or sell?
It's a hold for us, Ali. We think that they have benefited, certainly their cap rates, from reducing interest rates. We think that might turn into a tailwind. Also, we think the property cycle is reasonably mature, and going forward, they'll have to depend on more development work for their profitability. So we think the persistency of earnings, I guess, for want of a better term, will decrease. And also, the Paradise Investment Management acquisition was kind of a bit odd from our perspective. So we'd just rather sit back and watch for the time being.
Over to you, Simon. Charter Hall has an annual dividend yield of around 2.32%. Can that give investors comfort? Is it a buy, hold, or sell?
Ali, I think it's, for our money, it's a sell. It's been a real big beneficiary of low rates and declining interest rates over the last few years. That's boosted asset values. It's allowed them to increase the gearing in their vehicles as those asset values have increased. That's boosted fees, and it's also driven investors to the REIT market and institutional and retail, and allowed them to grow their fund. But with acquisition performance fees being over a third of their earnings, and we're just quite cautious on the ability for them to sustain that level of earnings. And like Bruce said, the Paradise acquisition moving into institutional equity management at this time in the cycle, I think speaks to the business looking for extra growth avenues, which we're pretty cautious on. So I think you've got to question the sustainability of earnings in their core business. Very late in the cycle, it's a sell for us.
Next up, we have Sonic Healthcare, which has seen its share price plummet around 17% since the beginning of the year. Simon, I'll stay with you. Is it a buy, hold, or sell?
Yeah, we like Sonic. It's a great business, Ali, and I think it's reasonably priced. It's okay, 25 times. COVID obviously has been a huge benefit for them as the world was tested more for COVID, and that's generated huge cash for the business. So Sonic has what will be almost debt free this year. So whilst the PE looks elevated 25 times, if you allow for the strong balance sheet, it's probably on 10 to 11 times EBITDA on a more sustainable level of earnings, which I think is reasonable. And I think COVID going forward will generate a new level of a new round of testing for pathology labs. So there's a new earnings stream going forward. Really good management team, and I think the balance sheet positions the company well to continue as they've done for many years their astute acquisitions, given they're the market leader in Australia, the UK, Germany, and number 3 player in the US. That creates a great portfolio where they can add on acquisitions at appropriate multiples, and they've done that for so many years, Colin and the team. So we think it's okay at these prices. It's a hold.
Bruce, over to you. Is Sonic Healthcare a buy, hold, or sell?
It's a hold, but I don't have too much to add, Ali, because Simon just took every single thing that I was going to say. But we think it's obviously a very good business, massive COVID beneficiary, and we see that as How that rolls off, we don't know, but the lasting benefit of that, as Simon mentioned, is the balance sheet, incredibly strong. We'd like to think they could deploy that through acquisitions and the like, but it's benefited all their competitors as well. So we think that acquisition side of things would be very competitive for them. Their core diagnostics businesses, radiology businesses and the like are very, very good. They've got sustainable growth. So it's a hold for us at the moment, Ali. We'd like to see how they come out the other side of this.
Okay, last but certainly not least, we have REA Group. It's seen its share price fall around 15% year to date. Is it a buy, hold or sell, Bruce?
It's just a hold for us, Ali, at the moment, verging on a sell. It is a very good business, the platform business, very strong domestically, and it's had a great market. We just struggle to see how they maintain the growth they have achieved, because they've done a lot on pricing, premium pricing, penetration, they call it. The property market's been extremely good, and it's likely to become, not roll off, but become a little more steady, which will that promote activity, which is what this company thrives on. So for us on a valuation basis, it's hanging on to hold.
REA was actually named by several of our fund managers in our Outlook series. It's a stock they would buy at a cheaper price. It's obviously sold off a little bit. Is it cheap enough yet, Simon? Is it a buy, hold or sell?
No, not yet, Ali. It's still very full. 41 times going to maybe 30, 35 times next year. There's a lot of good news in the price. And as Bruce alluded to, that there'll be headwinds going forward over the year in the housing market. So look, it's a great business. It's a great network effect. So they've got some pricing power. There's just a lot of good news baked into the price. We think Domain is a more attractively priced opportunity in that sector, and we're playing that by owning Channel 9, which has a 60% holding in Domain, which is quite a bit cheaper than REA.
Okay, we asked Simon and Bruce to bring along one beaten down stock that they think could be in for a rebound in 2022. Simon, I might start on you. What stock have you brought for us today?
Yeah, a stock that's probably not well known by investors is called Codan. The code's CDA, but this is a $1.5 billion business. Great management team, a good board, and it dominates a niche. It's a pretty niche product, handheld metal detectors, but they have clear market leadership position globally, and they've been outselling their competitors for some time. The business generates high margins and generates good cash for the business, and they've just reaffirmed their first half guidance last week, which saw the stock recover somewhat. But it's been caught up in this technology sell down. It is in the tech sector, but again, good management team, trades on 15 times, debt-free, which positions them for further acquisitions. And business that we think can continue to grow. Their other division is in the radio communications sector. They've made some recent acquisitions in that area, and they highlighted their update last week that those businesses have tracked well, and there's further acquisition opportunity for them to build out that portfolio in time. And so we think it looks pretty attractively priced at these levels.
Over to you, Bruce. Is there a stock that you've been buying in the recent sell-off that you think could possibly rebound in 2022?
We think WiseTech is a good opportunity at these levels. It has started to bounce. We've owned it for a little while, so we've readjusted our weighting there. But certainly, it provides software services to logistics, and now more than ever, logistics needs to operate well. There's stress enough as it is, but WiseTech is growing very, very strong in that. They've got a lot of the sector as clients, and it's a 5-year integration program, or up to 5 years. So they continually build revenue, not only from new client wins, but from existing clients as well. The price does worry us. It is something a little outside what we'd usually pay for assets, but we think they are creating a real moat around what it is they do. We think there's high barriers to entry. We think the network effect, they are becoming the system to use for any logistics players. So we very much like its long-term prospects, and happy to buy it at these levels.
Well, that's all we have time for today. Thank you to Bruce and Simon for your analysis. It was an absolute pleasure to have you on the show. If you haven't already, subscribe to our YouTube channel. We're adding new content every week.